So not every candlestick is the same. So base candles show that orders are potentially being accumulated by the institutions. So what are base candles? These are narrow range candles, small size candles. When compared to the other candles, visually very, very small, and ideally body less than 50% of the range. So that means if the range of the candle is 20 points, the body should not exceed 10 points. But this is not mandatory. Mandatory condition is the candle itself should be a narrow range candle. So how will it look like? Small range, small body, color can be red, color can be green. Doesn't make a difference. The whole idea is the candle itself should be a very small candle, narrow range candle. So I'm drawing one more candlestick here. So this candle that I have drawn, friends, does it qualify as a base candle? What do you feel? When you compare it to the other candles, the candle that I have drawn in blue, does it qualify to be a base candle here? How many feel yes? So mixed responses. So friends, over here the body is small, but is the range small? The range is not small. So what is this candle telling you? That this particular candlestick at one point of time was a solid green candle. It was trading somewhere here. Then the sellers managed to drive price all the way down. And then the buyers again managed to close it in the middle of the range. So this candlestick has consumed other orders. So it is not a good base candle. So ideally a base candle should be something like this, narrow range candles. So the range is big, do not consider it as part of basing. And what are leg candles? These are institutional footprints of buying and selling. Characteristic is when compared to the other candles, these are expanded range, big size candles. Not only the range is big, the body also should be big. Body greater than 75% of the range. So a red candle closing in the low of the range, green candle closing somewhere in the high of the range. So these are good leg candles. Leg candles should have almost full bodied candles. Big size, big range, big bodies. So now we are coming to supply and demand zone formations. So other name for formations is patterns. In conventional technical analysis, there are endless patterns. Only to name a few, you must have heard a lot: head and shoulder, inverse head and shoulder, pennant, flag, wedge, ascending triangle, descending triangle, double top, double bottom. So that list is endless. And the challenge with those formations is most of them are subjective in nature. So when you have subjectivity in your analysis, you cannot get consistent results. So we don't focus on those endless formations. We look at only two formations for buying and two for selling. The first, demand zone formations. The first formation is a drop, base, and a rally, also called DBR. Price is dropping down, sideways basing activity, and strong rally in price. So we can say a V-shaped or a U-shaped formation. Second formation is a rally, sideways basing, and again a strong rally in price. So friends, every zone, whether it is a demand zone, whether it is a supply zone, it is made up of three components. So what are those three components which are essential in every zone? The first thing is the basing structure itself. So basing, which is denoted by those small range basing candles. So for every zone, there has to be some basing, narrow range candles. Candles stick to the left hand side of the base. This red candle is to the left of the base. It is coming into the base. So that's why it is called leg-in candle. It is coming inside the base. In this case, this green candle to the left is the leg-in. Candle to the right of the base, which comes out of the base, is the leg-out. So over here, we have the leg-out candle. Again, over here, this is the leg-out candle to the right. So for a demand zone, it is mandatory that the leg-out has to be a rally. Only if the leg-out is a rally, it has to end with a rally, then it will form a demand zone. So two demand zone formations are DBR and RBR. Now coming to supply zones, they are just the mirror image of the demand zone. Rally base drop, price moving up, sideways basing, strong drop in price. Second formation is DBD, drop base drop, price dropping, sideways activity, strong drop in price. So here also three components: basing structure, left side leg in, right side leg out, right side leg out. So for a supply zone, the leg out has to be a drop. So only after you have all three components, then we say that the zone formation is complete. So let me draw a formation here. Valley, base. So is it any complete formation? Does it depict a demand zone? Does it show you a supply zone? Or is there something missing? So we have the leg in, you got the base structure. So what is missing here? The leg out is missing. So till the time there is no leg out, it's no zone. So from here, multiple possibilities. Price can just go sideways. Or else, instead of going sideways, it can form strong rally. So if it does a strong rally there, then we have a demand zone structure. But instead of a strong rally, if there is a strong drop, then we'll have a supply zone structure. So for us to identify whether it is demand, whether it is supply, we need to wait for the leg out. Only after the leg out, we'll come to know whether it's a demand or a supply zone.